than what you bought it at, of course. And then you have real estate, properties. You know that you buy a house, you probably can rent it out, or you can wait until the value appreciates and then you can sell it for more. And there are more types of investments. It's not limited to that, but I just listed some of the more popular ones, some of the more easily accessible ones. Not really real estate though, but stocks, bonds, unit trusts, those are offered at various entities. Now, I want to go over some of the best practices when it comes to investments, right? Because this can make or break the progress, or should I say, this can make or break the interest that you earn, how much money you make, and pretty much your enthusiasm to invest. First thing we need to do before we invest, we need to understand what we are investing in. We're putting in money, we need to know what we're putting in our money into, right? And there are a number of things. I just showed a few examples on the PowerPoint presentation right there. But we need to know fees. Some investment products charge management fees, right? And not ever it's not always outlined, right? Sometimes you have to ask, of course, unless you have a JMMB financial advisor or investment advisor where we give all the information you need up front, right? But some charge a management fee. There are some that charge a front end fee. So that is pretty much as you put the money in, as you invest in this particular product, a certain percentage is taken out, and that goes towards the company. So, and some charge an early encashment fee. You'll notice that there will be times when if you put in funds, you invest in an asset and you want to withdraw the money. Sometimes if you withdraw or in cash, I should say, before a certain time, you will notice that a percentage is taken out of whatever you in cash. So these are just some of the information we need to know prior to investing. I mean, we're putting in our money. We need to know all of the possible features that could see us lose some of what we put in. Right? We deserve to know that. Right? We're putting in money. We're investing. We're investing to make a profit. Now, another very important thing to note is the risk or the return or the potential returns of a product. Now, point blank, one of the first things we need to know about investments is that there is a very strong relationship between risk and return, right? The lower the risk, that means the potential earnings you can make or the potential returns you can earn is lower as well, right? Higher the risk of a product. If you are investing in a product and it is said that it's high risk, what that means is yes, the potential returns you can earn is high as well. However, the probability of you losing some of what you put in, some of the principal, is also higher. So we need to know that upfront. We need to understand that, right? So sometimes if you hear a product that earned, let me give an exorbitant percent, let's say 50% last year, in 1 year, 50%, that is a large amount. So immediately we would know that, okay, we would have to ask what are the risks associated with investing in this money, because we know that it will not be 50% every single year, right? So this is something that we need to know prior to investing in an asset. We also need to know other important features of these assets, like interest payments, if any, or dividends, right? As mentioned earlier, bonds are a type of assets or investment financial instrument, and typically bonds pay interest payments every 6 months, right? We need to know.
We couldn't hear.
Wait, are you hearing?
Hima, we're hearing you doing. Go ahead.
Okay, yeah. So other
We'll
important fee.
have this slide. We'll pass the questions, but go ahead, doing.
Okay, yes. Other important features such as interest payments, if any.
Please mute your mics, everybody. Mute your mics.
Yeah, interest payments, if any. So some investment instruments pay interest. We need to know what are the interest payment dates. It's very sometimes it's well for the most part it's very specific. So you will know that, for example, you will get interest February 15th, 2021, and 6 months later, like exactly 6 months, like we know the exact day. So we need to know all of this so we can better manage our cash flow. We can know what to do with these interest payments if we get any, and all of that, whether to reinvest, whether I want to spend it on something else. These are things that we need to know. We need to know the features of the product as best as possible, right? Maturity date. Bonds, for example, again, you will hear that they are like, yes, every bond has a maturity date. So we need to know that when it matures, you get back the principal amount. We call it face value that you put in. So we will need to know exactly when that date is so we can better plan for it, so to speak. So we know whether to reinvest it, put it in something else, buy another bond. The possibilities are endless. And we also need to know the underlying assets of a product as well, because some investment instruments have underlying assets, whether it's treasury. I'm going to list up some examples, whether it's like treasury bills, bonds, stocks, um, real estate. Based on these underlying assets, we will be better able to know what are the risks associated with this product, and we'll know if it's best or if it's suitable for you as an investor, right? Page 5. All right. One of
Let's
those.
let's 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 pause there a little bit, doing.
Yes. Yes.
All right, just go back to that previous slide for me.
Mm-hmm.
All right. Any questions here, family? Anything that you just want maybe doing to clarify? One question from you, doing. How do you when is a risk too high? Is that really up to the investor?
It is up to the investor, right?
Yeah.
So that is when you have the discussion with with the JMMB advisor, right? Um, and it gets much more complicated to have a holistic discussion whether something is too risky, because we have to take a lot of things into consideration. And we'll get to that later,
Okay.
right?
Okay.
Yeah. Okay.
All right. Cool. Any questions? Any questions here from anybody? If not, go on, doing.
No questions? Okay. Okay. All right. One of the other best things to do where investment is concerned is invest early. What is early? To me, early is as soon as you learn about it, you start, right? Um, Investing early can benefit you in a number of ways. One of it is it can improve your spending habits. If you invest instead of buying other things, I won't get specific, it's likely for you to have financial freedom sooner than later, right? But the most important thing, in my opinion, when it comes to investing as early as possible is that the interest compounds. What I mean by compounds is simply you earn interest on top of your interest. So let's say, let me give a big amount. Let's say you invest $500,000, right? Let me take out my calculator. Let's say you invest $500,000, right? Everyone's in the calculator?
Not quite, but go on,
Oh, okay, all right. Let me just say it still. If you invest $500,000 and you earn 7% in 1 year, that is plus 7. That means you would earn 35,000 in that 1 year, right? Now, if year 2 you earn the same 7%, that would be 37,450, right? And if year 3 you earn the same 7%, what you would earn is $40,071.50. So you earn interest on top of your interest. So even if you are earning the same percentage as a dollar value, it will be more. Everybody clear?
Yes, got
Yes,
that.
I'm there.
Yes. So that is the most beneficial thing when it comes to investing early, right? If you want to really achieve financial freedom as best as possible, that is something that we need to start doing. So if everyone is not already investing, as soon as we're through here, by tomorrow, I need everyone to get at it and start doing it as early as possible, because the earlier the better, pretty much. All right, page 6. All right, now this is it now. Another thing we need to do as investors, we need to carefully consider our specific situation. What I mean by that is, what is best for me is not what's best for Jas, and that's not what's best for Jeremy, and everyone is different, right? We're all different. We have different goals. We have different circumstances. Um, we have, I mean, we're not all the same age. All of that. Now, when we carefully consider the situation that we are in, we will better be able to choose or recommend. Well, no, you as an investor will be better able to narrow down which product or group of products would be best for you, right? Let me give an example. Here on the slide, age is something that you should take into consideration. Um, how long before you need the funds, your tolerance towards risk, and your overall investment goal. Now, let me give an example. Risk tolerance. There are a number of different financial instruments, right? Investment related products, and they carry varied levels of risk. Varied levels of risk. Now, there are some investors that could invest, let me use the same 500,000, right? Just for argument's sake. And in 4 months, when they look at the value of the investment, it's now 350,000. They lose 150,000. 150,000 in just a few months. It is a possibility. And some investors would just be like, oh, that's fine. It's okay. They expect it to go back up soon. And then there are some investors that if they see that in their portfolio, if they see the value go down so much, especially in such a short space of time, it's like it's like an anxiety attack. Can't manage, and that's okay, right? Everybody is different. Not everyone can tolerate that risk associated. Now, if you know that you are that risk averse investor, you don't want to ever look at your account, look at your portfolio, and see the value drop, especially drop by a large amount, then you know that certain things would not be for you. Example, stocks. Stocks are the riskiest type of assets, right? So when you put money in stocks, we would, let's say for example, we would tell you to, it's best to invest for the long term, right? And it's, you need to understand that it will fluctuate. And the reason why we specify for the long term is that the market will fluctuate, it will go up and down, right? So the investment will do this from time to time, but in the long term, we anticipate or we expect that it will appreciate in value, right? So if you know you will need the money in 2 months, then we wouldn't tell you to put your money in stocks, because it's a possibility that you might invest in stocks just for argument's sake, and you put in 500,000, and when you're ready for it, the value gone down to 400,000, and then you won't be a happy camper. right? And it's also important to take your investment goal into consideration and stick to it. And I can give an example of that as well. If you, let's say you are a 30-year-old and you want a retirement supplement, you want to, when you retire, other than the pension that you will get monthly, you have money saved up. This, I mean, you work 30, you work for so many years, you finally retired, you want to enjoy life, you want to go on vacations, you want to buy a lot of things, you want to have fun. Understandable. If you're 30, that means that your investment goal is in 30 plus years because the retirement age is like 60 to 65. If 2 years in investing when you're 32, you look at your portfolio and see that it dipped a bit, there should be no reason to be alarmed because you have a very, very long time horizon, you have a long goal, right? So just keep the focus, continue to invest, right? And work towards that 30-year retirement goal that you have, just for argument's sake. All right? Everybody clear?
Yeah.
Clear.
Okay, great. So, I mean, and this is just a small portion, as I said. There are a number of things to take into consideration, right? Now, other thing that we as investors need to do is diversification. We need to diversify our portfolio. And what I mean by diversification is this is simply investing across various asset classes in various assets, right? Now, most of us, if not all of us, have heard the statement or the saying, don't put all your eggs in one basket. How much of we all hear that, right?
For sure.
Right?
Yeah.
The premise of diversification relates to that in a sense. Now, if you put all your money, if you invest all your funds in one asset, one thing, and that one thing goes south, it goes under, what do you do? There's nothing you can do. You just have to bear the losses. I wouldn't want that, right? No one would want to invest their hard-earned money and then everything just collapse. When you diversify, instead of putting money in that one asset, you invest it across so many, let's say for argument's sake, even 5, 6 across various asset classes. So even if one goes under, you can lean on the other assets that you have invested in for support. So the potential appreciation of those assets would see your overall portfolio still staying afloat, right? Instead of everything going under, right? So diversification, you put when you diversify your portfolio, you minimize the risk of losses, and off should be there. So you minimize the risk of losses to your overall portfolio, right? And as a result, it reduces volatility and there are more opportunities for returns, more opportunities to earn interest. And the reason why that is so is you invest across a number of assets, a lot of them, instead of just one. So it is likely that at least one of what you have invested in will appreciate in value. It's likely. So those are some of the benefits of diversification. And we as investors should prioritize this because it is the best mitigant towards risk. Best. Another thing. Now, let me go in quickly into some of the mistakes that many make when investing. Common mistakes, understandable, but it happens. Now, not understanding the investment. as discussed earlier, if we are going to invest in something, if we're going to put our money into something with the expectation to turn a profit, we need to fully understand it. Now, I'm not saying we all should be analysts and specialists and know all the mathematical ratios needed to analyze something. No, it doesn't have to be that deep, but we should at least have some of the basics, some of the general understandings of what we are putting our hard-earned funds into, right? Need to understand. Let's say as someone who is in the field, what I have heard a number of times is, let's say clients come in shocked or maybe upset that their portfolio has reduced in value. Now, of course, I would then explain that based on the type of product that it is, it will fluctuate from time to time. It's nothing to be alarmed about, but that's just how it works. The market is currently down, so this particular product is invested in Jamaican stocks. Stock market is down, so this will be down as well, right? And then, but it's a case where they didn't have the proper or the full understanding of how the product really works or the underlying assets of this product. So when it dipped, I mean, when it's performing well, everything is good. But when the market turns and then the value of the fund goes down, it's an issue. So I believe if you fully understand what you're investing in, if you fully understand the product, it will greatly reduce the possibility of this happening, the possibility of you being shocked or upset that the value of whatever it is that you have invested in has gone down, right? Another mistake to avoid when investing is making emotional decisions. And I can explain what I mean by that. Now, let's say you want to invest in a company. Let's say you want to purchase stocks. I remember I said earlier, stocks. You purchasing stocks is you purchasing ownership in a company, right? Now, you buy stocks of a company because you like this company. That's the only reason. This company is the best thing since sliced bread. You love them going to bed. They can do no wrong in your eyes, right? You love this company. However, brokers and other experts, analysts have done their research and unanimously in this same company that you love, everyone said that, okay, this company is not in a good position and we don't foresee things getting better for them, right? And they recommend investors reduce exposure in this company as much as possible. But you're not listening to that because you love this company. So you continue to buy more of their stocks and you invest in them as much as possible. And then 3 months down the line, the company goes under. The company is getting delisted from the Jamaica Stock Exchange. Terrible things happening. No, you've already invested so much of your money in this company, all because you like them, ignoring the actual research and analysis that was done on this company, right? So if this company goes under, your money goes under with it. No, that's an emotional decision, and that's what we shouldn't do. And it happens. I mean, we have a liking towards things, we have preferences. So we understand, but we should try our best to not let that be the case, right? Try our best. We don't want to make emotional decisions. Make we don't want to make financial decisions with our emotions instead of analysis and facts and projections or other research that was done. Right? Am I right, everyone? No answer?
Yeah, man, you're good, man. Following you clearly. Following you.
Okay, okay. Another thing, another mistake to avoid is failing to diversify your portfolio. You know, as discussed earlier, the importance of diversification. So if you don't diversify, you put all your eggs in that one basket, and then that one basket falls, all your eggs break, right? All your money gone down. That's that. No one wants that. We don't. I mean, as we said, we invest money to make money. We invest to turn a profit. That is the purpose of investing, right? So if you don't diversify and you put all the money in one particular asset, and that one asset goes down, all your investment goes down with it. So that is, I mean, we can't stress the importance enough when it comes to diversifying your portfolio, right? So failure to diversify is one of the mistakes that many investors make. So when we leave this and we start to invest, everyone should have a diversified portfolio, right? Especially if you're investing for the long term. Okay. Another mistake is always trying to time the market. Now, timing the market, what I mean by timing the market is purchasing assets when the value is as low as possible and always trying to sell it when it is at its highest. Now, that is an immensely difficult thing to do. Even people employed in the field have difficulty doing that. And the reason for that is the market, it moves so quickly. The market can turn with the breaking of a news, right? So the price of a stock, for example, can plummet because a news broke at 12:01 in the afternoon. And then as soon as it comes out, you see the price for the stock just, or whichever asset, sinks. That is why it is tremendously difficult to time the market. Most people don't look at what's going on for every single company 24/7. And if you're not looking at it 24/7, it becomes tremendously difficult to know exactly when to sell or when to buy a stock, right? Impatience. And let me tell you what I mean by impatience. Now, if you purchase an asset, um, and in your mind, you initially say that, okay, I'm going to hold this stock or this particular security for 5 years. 5 years. After 1 year, the price goes up a bit, but not as much as what you anticipated. So you just, kiss the teeth and say, I'm a care about this. This now make me no money. Sell it. What can happen is that as soon as you sell this particular asset, the price skyrockets and then you miss out on that. Because we didn't stick to the goal of staying invested and investing incrementally for 5 years. So that's what I mean. It's important. I said it earlier, it's important to stick to your goal, right? It's very important. So that's a mistake that many investors make. Yeah. Now, let me just go over just a very few investment options, right? There are stocks, which as I discussed earlier, is ownership in a company, right? You have different types of stock. You have preferred shares, you have preferred stock, you have ordinary stocks or shares. Um, so there are a number of different stocks, right? There's bonds as well. Now, that, as I said earlier, it's a debt instrument. It tends to pay incremental interest payments, usually every 6 months. It shares some unique factors which we need to know before we're purchasing into it. Let's say, for example, a bond can default. And if they default, what happens is you either won't get your interest payments or you possibly won't get the money that you invested in, right? The face value. You won't get what you put in. That could be a very bad situation. So we have to know exactly what it is that where we are investing in and see if it's best for us. Because as I said earlier, not everything is best for everyone. Um, then you have unit trust. Now this is unit trust is a good option. It is a good option for the investors who don't have time to really sit and watch the investment and try to time the market, as I discussed earlier, buying and selling, because it is managed by professionals. So you invest your money, right? You are assigned a number of units, and the value of these units either increase, decrease, stay the same. It all depends on what's going on in the market, and you don't have to watch it every single day. I mean, well, it's good to keep abreast of your investment, but it is managed. And then there are other managed funds. Here at JMMB, we have a product called the Wealth Builder, which is a very diversified. Remember, I talked earlier about the importance of diversification. It's a diversified product that's invested across a number of different unit trust products invested in different things: bonds, money market instruments such as treasury bills and repurchase agreements, real estate, stocks, and once again, it is managed. So the managers of these funds would rebalance the proportions of how these products, proportions of how the funds are invested that is suitable for you as the investor based on your risk tolerance and a number of other things, right? And then you have repurchase agreements. Now, we are JMMB, we call it the sure investor. Now, what that is, it is aimed towards investors that don't want to risk their money. It is you get a fixed return. So as soon as you invest the money, if you keep it for whatever the agreed tenure, whether it's 7 days, 30 days, 60 days, 90 days, 180 days, 365 days, you know exactly what it is that you will get. Right? You know whenever you encash the funds, if you keep it for that specific time, you know exactly how much money you will receive, right? So it's a very good option for those who, let's say, have a very short time horizon. Let's say you plan to purchase a car cash in 4 months. 4 months when it comes to investing is a very short time. So you want to earn more than you would than a regular savings account, but you want to keep your funds as safe as possible while earning more than a savings account. This is a very good option right here. Now, each of these products, based on the institution and a number of other things, they have terms and conditions, which, as I said earlier, you have that discussion with the advisor and let them outline everything that you need to know before you're purchasing. Let's say, for example, repurchase agreements. If you agree to purchase, if you agree to invest for 30 days, but you want to pull the funds or encash the funds in 10 days, it is likely that you will get a penalty. You will have to pay a penalty, right? So these are just, I mean, that's just one of the examples of something that you need to discuss with your advisor before actually putting your money into a particular instrument, right? When you know all there is that is to know, that when you know all that there is to know about a product, it is likely that you will end up choosing something that is tailored specifically for you, and that it will definitely be to your benefit, right? There is one thing. Let me go back. Let me backtrack a little. One of the best practices, never mind the invest early part, but one of the best practices also is investing regularly. Regularly. So, I mean, we can look at our budget to see how much it is that we can afford to invest on, let's say, for argument's sake, on a monthly basis, right? And the reason why this can be very beneficial, especially if it's a case where you have a long-term goal, you experience what is called dollar cost averaging. Now, dollar cost averaging, what that is pretty much purchasing assets from time to time at different prices. So let me use JMMB for example. If you purchased JMMB stocks, JMMB shares last year when the price was $50, right? And you made the decision to purchase, a little bit every single month. Right now, the average that you would have paid, that you would pay, yeah, that you would have paid for the JMMB stocks would be less than the 50, because right now JMMB stocks is trading at roughly $30, right? So if you had 500,000, I'm using that number quite a bit, but if you had 500,000, I would put 500,000 JMMB stocks a year ago when the value was $50 per share. You would probably regret it now because it's the value gone down a bit, right? So that is one of the reasons why investing regularly and incrementally purchasing these assets can be very beneficial to us as investors. All right. I've been talking a bit. Time for everyone else to do the talking. Any questions, anyone?
Thank you, Dwayne. Just you can just close your share screen, please.
Oh, okay. Stop share. Okay.
All right, great. All
Mhm.
right, thank you, Dwayne. Morning. I have a few questions, but I'm just going to open the quote unquote floor for any questions anybody may have. You
Mhm.
may raise your hand or you can type in the chat or just unmute your mic, identify yourself, and ask your question. Anybody have any questions? I have a question, Dwayne, and while they figure,
Mhm.
is investment only for young people?
No,
Meaning once you're above a certain age, you should not invest,
definitely not.
right?
At any age, you can invest. Now, it will be very specific to your situation.
Right,
Typically, not all the time, but typically, the older investors tend to be more risk averse. Yeah, sorry about that. Tend to be more risk averse. They don't want to take much risk with their money.
right, right.
Now, there are some products that are very low risk, right? So, if an older person wants to invest in something that earns more than a regular savings account, of course,
Mhm.
but want to be as want to be safe or conservative with their money, they don't want it to fluctuate a lot, there are options for them as well. So it's not just for young people, old people, middle age, everybody can invest.
Gotcha. Good question. All right, thanks. Any other questions? Thanks, Dwayne.
Mhm.
All right, I have another one since somebody's asking. In this, in this, in the middle of, we're in the middle of a pandemic. I don't know if the middle or the end or the COVID-19 pandemic. I'm sure it has impacted on a lot of investment values, whether stocks and stuff.
Definitely.
How should an investor view this time when in a pandemic? Should you be more cautious? Should you what would you say should be the attitude of investors at this time?
Okay, well, let me say this. Now, as I said, there since this COVID-19 pandemic, there have been a number of investments, to say the least, that have been reduced in value, not performing anywhere close to what it did last year or the year before, or probably the year before that as well. Now, you asked if we should be more cautious. I definitely think so because of the uncertainty that surrounds this pandemic. Fundamentally, it is a health crisis and it is impacting a number of businesses and governments that would inevitably impact the performance of these investment instruments that we want to invest in, right? So we should be more cautious. However, remember earlier I said that we need to pay careful attention to our situation. Right now, for some investors, this would be an opportunity to invest. Well, I won't say dump money in it, no,
Right.
but to invest more because as we discussed, the value is now low, right? Now there has never ever been anything, any situation, World War II, the 2018 financial crisis, there has never been something that permanently keeps the stock market down. Never.
Okay.
It recovers. It always recovers. We just don't know exactly when,
Okay.
right? So if an investor has the risk appetite to purchase stocks, let me not say stocks, to purchase securities or investment instruments incrementally, maybe a little bit each month. If they usually purchase before COVID-19, if they usually put in 50,000 a month, bring it down a notch. Maybe put it to 10, 15, based on the situation, it varies. But put in a little each month, and then when the economy and the market recovers, we anticipate that the value or the performance of these investment instruments will recover with it. So it is actually a good opportunity for the investors with the risk appetite, right? Who knows that okay, right now it's not good, but it's likely to improve eventually. And for the who has the time horizon as well, the long-term investors. So there is opportunity there. So
All
it's
right.
it's it's not really a case where I hear people say that oh it's COVID time, it's not a good time to invest. Not necessarily. It's more than that. It's a more detailed discussion than that. And I think there's an investment for everyone at almost any given time.
All right. All right. Because I'm using my phone, I can't see chat questions properly. Justin, could you read me the first question there from Venice? I saw it come, but I can't see it. Justin, could you read my question?
From Venice.
Yes.
Is now a good time to invest in US dollars?
All right. That is a difficult thing to answer definitively, and let me tell you why. Now, the foreign exchange market tends to be it tends to be volatile. A few weeks ago, the US dollars was 150 to yeah, 150 to our Jamaican dollars, and then it went to like 141, and then it went up back to 148. So it's very volatile. Now, if you're investing with the intention to sell the US dollars eventually to buy back Jamaican dollars, I would say do that only if you want to invest for the long term. And when I say long term, I'm talking about 5 to 10 years, because I mean, past performance is not a guarantee of what will happen in the future, but the US dollars tend to strengthen against Jamaican dollars. It happens, right? So if you have a long-term play, then it could be a good time to invest. But if you want to do something like invest, like purchase US dollars today, for example, and then sell it in a few months, I wouldn't necessarily advise that, because I can't definitively say that the US will reach X amount in value compared to what it is today.
Got you. Any question? We take one or two from the chat. Any other questions?
Yes, I have two more from the chat. This one is also from Venice. This was actually
no. Read. I think there's one from Emily. Read one from Emily. I thought Emily have a JMMB one. See that for last. She had another one. Ask that one.
So I only have three in the chat: Venice and Emily, and the second one from Venice.
Okay, read Emily's one.
Emily says most financial companies offer, I think she's saying offer right here, offer the same products. Why should I choose JMMB over other financial companies?
Virgin, don't give us a 10 hours version. Give us a 2 minutes version.
Emily, good question, Emily. So, well, you are correct. Many investment houses do offer not the same, but similar products with similar composition and similar underlying assets. But what I can't speak on any other company. I can say with us here at JMMB, we really target, well, I want to say target. We aim towards you achieving your goal. That is all that it's about, right? Regardless of what that goal is, that is what we want. We want to assist you in reaching those goals. Now, based on that, we can tailor something very specific on what would be perfect for you in helping you to reach that goal. As I said, I can't really speak on other companies, but we here, we don't really push the rates like that, because we know rates fluctuate. It's all about achieving a goal. And the reason why you should choose us is because we prioritize our clients in achieving what it is that they want to achieve. That's it.
Thank you, sir. All right. Any other questions before we take other one from the chat? Oh wait, my wife beside me, she has a question. My wife is just, I'll turn the screen to her where she answers.
Okay, good evening, everybody.
Hi, good evening.
All right, this is for persons who are maybe, say you're at in your late 30s, 40s going on. Maybe you don't have no retirement account or anything like that. And I remember last week, Brother Simpson brought up the point about retirement, planning for retirement. What type of, how do you recommend someone like that would approach retirement planning?
Okay.
If I hear well, you're saying if you start retirement planning late,
right,
what would you advise?
Okay, well, if it's late, it's still time to get started. You don't want to wait any longer, right? So if they have no pension whatsoever, I will definitely advise them to open what we call JMMB RS, JMMB Retirement Solution. That is an approved pension scheme, right?
Mhm.
I would tell them about that particular product, and give them the features. I don't want to get into all of it now because it's a bit much.
Fair enough, fair enough.
But I'll interest them in that, and I'll also give them the details about other products that I believe can be a good retirement supplement for them. Also, I will analyze their budget to see how much it is that they earn a month. What are their expenses? Do you have an emergency fund? That's something I should have brought up earlier, by the way. Do you have an emergency fund? So if anything happens, you don't dip into your investment for that. You have money that can cover your emergency. And based on that, we work out a plan on a monthly. I would choose monthly because most people get paid on a monthly basis. So I just work out how much it is that he should invest every single month, right? Every single month, and do a projection on what it is that he can earn if he sticks to that goal, right? Now, of course, we need to come up with we need to come to a compromise. So he should tell me, or we should discuss how much it is that you would want to have there put down for you, for him, I should say, when he
Or
retires,
her.
or
Yeah.
her when he retire, when him or when
Right.
she retires, right? And then I just calculate it, give him the details so we can get started quickly. I mean, one of the first things I said was to invest early, and I also said that the what I call early is just to invest as soon as they get the information, right? And as
Right.
soon as we know what to do. So it's
All right.
late in the grand scheme of life, but just get started.
All right. Yeah, follow-up question. Angela, I see your hand. Just as soon as you, Angela.
Yeah, not so much on the retirement thing, but I know earlier the examples you were using was like 500,000. And so is it that if I don't have that type of money, I can't invest? I have to
Mm,
have big money to invest?
no, man, that's definitely not the case, right? I mean, okay. So remember earlier when I was saying that we should know the details about the product or products that we're investing in. So some products have different minimum requirements. Some, and this is across the board, by the way, not even just JMMB. So let's say, for example, let me use JMMB. We have a product called the Smart Investor. The minimum to invest in that is 100,000 Jamaican dollars or 1,000 USD, right? There's the Sure Investor with a bigger minimum requirement. However, we do have other investments that you can start with as little as, let's say, 6,000, 10,000. So it doesn't have to be this large amount of money. We can start with little, just get started.
Thanks, Dwayne. Angela, you can unmute your mic and ask a question. Unmute your mic, ask a question.
Just to say, somebody want to open a pension plan, right? And work, yeah, just give you a figure, $7,000 a week and get paid every fortnight. What are the requirements to open that pension plan?
Oh, the requirements to open it. All right. There is no minimum requirement when it comes to the pension. There's actually a maximum. And the thing with it is, firstly, we can't have multiple approved pension schemes, right? That's the first thing. And the second thing is that you cannot put more than 20% of your income into it, right? There's no minimum. If 1,000 amount is what you can put, that's fine. There's no minimum.
Look here,
But
I'm not the math brain type for the 20% thing. But as I said, the person work 14,000 every fortnight.
yeah,
How much would they able to put in?
alright.
To open the
14,000 per night.
Yeah.
Alright, so that are roughly 28 a month. Approximately, I should say.
So you'd have to do that every
About
month.
$2,800.
It wouldn't be that would have been for the month or for the fortnight.
Wait, what would be for the month or fortnight?
Yeah, how much I would have paid for the pension?
All right. Remember I said, with as long as it's not more than 20% of that amount. So as long as they're not paying more than 5,600
Right.
every month, because that's 20% of 28,000, right? So if they can contribute 3,000 a month, that's fine.
Okay.
Cool. All right, thanks, Dwayne. Thanks, Angela. Remember to mute back your mic, Angela. I just read that question from Venice. We have a few minutes. Read a question from Venice.
Which investment beats inflation and has low risk?
Beats inflation and have low risk. All right. Inflation, what is the inflation level? I think it's about, don't quote me, but I think it's about 4.5 or something like that. No. All right.
If you don't know, it's a tough question. Don't, it's fine. Because
yeah. I think it's about 3.9 something. That was the inflation rate in 2019 Jamaica. So what investments beat that and have low risk? Well, there are actually a number of them, There are actually a number of them. But this is important now. Some of them don't give a fixed return. So let's say for example, there's a product that is considered low to medium risk last year that did better than 3.9, the 3.9 inflation rate. This year, it doesn't guarantee that it will beat inflation again. So that's something to note as well. Unless the interest rate for this investment is fixed, unless it is fixed, we can't say definitively that it will beat interest rate, that it will beat inflation.
all right, thanks, Dwayne. Any last questions from the group here? All right, Dwayne. Any closing comments you have? The topic actually is wise invest. Any closing comments? What's one of the main takeaways? What's one of the main points you'd like to drive home as we close?
All right. So the main point.
1 point. Yeah.
One. All right. I would say, let me say 2. You know what?
All right, I'll give you 2.
Let
I'll give
us
you 2. Go
combine
ahead.
them. Invest early, right? And know what it is that you are in. 3. Invest early, right? Know what it is that you are investing in. Know the details, and invest specific to your situation, right? If you know that you cannot manage, like your heart can't take the risk, your heart can't see your investment fluctuate, don't put your money in the high risk product. All right?
Cool. All right. Thank you, Dwayne. Really appreciate it. Again, the content is available. Will be available on our YouTube channel. Thanks, Dwayne, for taking your time, and I think Andrew O'Connor may still be on. We know Andrew from Hampton Green Days, and Andrew, who's at JMMB. can link us up to Dwayne. So thanks, Andrew, and the folks at JMMB. Really, really appreciate your time and you being with us here. All right, so remember, church, we resume physical meetings on Sunday. I know tonight was some Wi-Fi issues, so it wasn't as smooth, but I'm hoping that we would have gleaned some information from what Dwayne shared. If you need contact, you can contact me afterwards for his contact. If you have more questions of Dwayne. All right. We're going to pray now. As usual, we're not just unhide our videos and say goodnight as we go. So let's pray together as we close.
All right,
Father, thank you. Go ahead, Dwayne.
I just want to thank Harbor View Gospel Chapel for having me. You know, it was my pleasure. I appreciated it. Thanks for giving me the time. All right, I appreciate it.
Cool, and Dwayne, no problems. It was good having you. All right. Thanks, Father, for tonight. Again, God, we ask the Lord God, you give us the wisdom to leverage all we have heard according to your will. Lord, handling the resources in our hands very sensitively, because really yours. God, help us to be wise investors, Lord God, and help us to honor you in all our ways. We thank you, Lord God, for Dwayne. We ask your blessings on him, on his family. And God, we ask continue to pray for us all and help us to grow in wisdom. God, give you all the glory in Jesus' name. Amen. Thanks again, Sir Wade, and good night, everybody. Feel free to unhide your screens as we say good night. We remember for me next Wednesday, God's willing, on Zoom, unless otherwise advised. And we hope to look on giving next week. Look on budgeting last week, investments this week. Next week, look on giving as we close our series on stewardship. Big up to Chincy. Yo, Angela. Hey, Brother Simpson. Hello, everybody else. Hey, Jess. Hey, Sister Yannick. And everybody else that's there, Carmen, Altino, Rich, Cynthia, Miss Simpson. Hey, Sharon. Hey, Gumbe. How are you? I hope you
cut off a while ago.
cut off.
Time to go up and go down. That's why more time when I catch a meeting.
Is that right? I understand. You did well this evening. Right. I'm into our Wi-Fi issues. All right, bless you guys. We'll upload this on our channel about Friday. So you'll be able to see that. Benny is another investment expert among us. So if you have any questions, I'm sure Venice is more than that's why Sharks always have questions in the class. I go on like, you know. So if you have any questions, I'm sure she's there to help you as well. So, Angela. All right, bye everybody. See you guys on Sunday. See you guys on Sunday as we meet at church, 64 Dorado Drive. Good night.
Okay, bye.
All right.
Everyone.
All right, yeah.
Adios todos.
Just go ahead and close it.
Hasta la vistas.
Hasta la bye-bye.
Okay, cool.